Major projects like infrastructure constructions, global trade contracts or merger and acquisition deals can require extraordinary sums of money. Financing deals such as these take more than a simple bank loan. They carry financial, commercial and legal risks which investors want to limit. A combination of solutions is needed to provide the necessary funds, spreading the load so that banks do not carry all the risk and investors can rely on broad, strong foundations for such investments. Such deals involve complex contracts and corporate structures to protect investments. This is also called structured finance. Corporations, financial institutions and even governments use structured finance for their large investment projects. This type of financing provides efficient access to numerous sources of capital and spreads risk across different asset classes, geographies, industries, instruments and credit risks. Structured finance is a vital part of our economies by making investment secure and thus possible. Indeed, it would be more difficult to raise the capital needed for major projects. Some financial centres have specialised in helping to structure such investments. They are called investment hubs. Luxembourg is one of these specialised hubs. Luxembourg banks, lawyers, tax advisors and other professionals have developed over many years the necessary expertise needed to help structure such investments. The legal and regulatory framework has created a raft of different structuring options that allow investors to choose the right solutions for different projects. The wide use of English as a working language in Luxembourg, including with public authorities or within its commercial tribunals, contributes to its appeal to global investors.
Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Good morning, ladies and gentlemen, and a warm welcome back to our series Focus On after the summer, which I hope was restful to all of you and that we find you with your batteries reloaded for another few months of intense work until Christmas. Today, we would like to focus on investment structuring. As many of you know, Luxembourg has over many years now become one of Europe's leading hubs for structuring investments. This activity is what we're going to try to demystify over the next 1.5 hours, explaining in what it consists, explaining what criteria investors use when choosing a jurisdiction over another, what considerations preside over this choice. And we will also, of course, address the fundamental changes that the tax framework in which this activity operates has seen over the last 10 years. Indeed, what we will look at first with our Finance Minister, Pierre Gramegna, is what the reforms that the G7 and the OECD are about to enact will actually entail for the industry and for a country, an investment hub like Luxembourg. Please welcome Pierre Gramegna, Luxembourg's Finance Minister. He couldn't make it to our live recording this morning, but we have pre-recorded his interview, and here is what he has to say about the reforms initiated at the international level. Minister Gramegna, welcome to this episode of Focus On, dedicated to investment structuring. And we would like to address with you some of the international questions that arise around investment structuring, in particular the reforms that have been launched by the G7 recently in the spring and that now are being worked on at the OECD level. Maybe you can start by telling us what these reforms are going to be about.
Well, thank you, Nicolas, for focusing on the issue of global taxation, which is really going through a phase of total reshaping worldwide. The OECD has been the mastermind of these reforms starting from around 2010 until today. And we had a very first package that was agreed in 2015, which has now been implemented in many countries, in most countries, including the European Union. So we have the Anti-Tax Avoidance Directive 1 and 2, which were implemented where Luxembourg was very much involved, both in working out the European version together with the European Commission, which also happened during the Luxembourg presidency of the EU. And in fact, Europe has in some instances even gone a little bit farther in harmonizing and doing things to avoid unfair taxation. Because the goal of all this is to have a system worldwide that is fair in taxation and at any rate fairer than what we have known until today. One must also be aware that taxation internationally has not moved in the last 100 years and was based on the concept of permanent establishment. So the seat of the company and the reforms that are coming now will change that. Now, very recently, the G7, the G20 in particular, and then the OECD have been able to find a compromise which is nearly finished and should be confirmed in October at the OECD, which foresees a new system for global taxation for very large companies. And as probably many of the listeners know, there is two pillars that have been part of the agreement. Pillar 1, so-called Pillar 1, is to have a kind of global taxation for large companies that is fairer than what we know today. And this is applicable only to companies that have a turnover of over $20 billion. And for companies, second criteria, that have a profitability that is over 10%. So if you fulfill those two criteria, you will be subject to this new system of global taxation, which will cover a few hundred companies worldwide. So it's obviously a very limited scope in a sense, but these companies are very large companies worldwide. And what will happen there is that a part of the taxation for these very large companies will be allocated to the market jurisdiction. That means that 20 to 30% of the tax that the company must pay will be allocated to the different areas where the company is working. So away from the notion of permanent establishment. So that's very important to keep in mind. The second thing in this pillar 1 is to keep in mind that extractive activities, that means base materials, raw materials, are excluded, as well as financial services. So that was one issue where not only Luxembourg, but many countries have insisted on, because financial services is such a special industry that it would make no sense to submit the financial industry to this pillar 1, which has then carved out financial services. This system is fairer in the sense that it will look at the coverage that a company has worldwide, and will make sure that also developing countries will have a part of the cake.
That already goes into the direction of answering my second question, which is that will this reform actually provide an answer to the calls for a better, or as you say, fairer taxation of the digital economy?
Well, we have to add to the measures I've just described the fact that there's the Pillar 2 element, in this context, which foresees a minimum taxation worldwide. And the minimum taxation worldwide will be probably at a rate of 15%. It's not definite yet, it could be higher, but my guess is we will be at 15% minimum taxation on a country-by-country basis. That means there will be a close look how much you pay in every country. That means for a country like Luxembourg that has lots of subsidiaries, the subsidiaries will be looked at, or the mother company will be looked at, and it's always 15%. So this is obviously a very good element of fair taxation, because this will be implemented worldwide. So if you do not reach this 15% at the level of the subsidiary or the headquarters, then there's a whole range of rules that play out. And in fact, the rationale of the whole idea is that no country will have any interest in having a lower rate than 15%, because if you don't pay it in one country, you will it will be taken back in another country, in the headquarter country. So it will probably make sure that we'll have this minimum taxation rate worldwide. Now, out of the 140 countries that are part of the OECD inclusive format, 133 have already said that they agree with all of this, the Pillar 1 I have described before, and this minimum taxation. Luxembourg is part of these 133 countries. We've been very proactive in the discussion. We've negotiated very much in detail. We've been very constructive. And as a result, we are reasonably happy also with the result. On top of it, because we also have been able to have a carve-out of substance, which was something that for EU countries was quite important, and which was for Luxembourg quite important, especially because we are very active in the field of services, where it is important to have such a carve-out. So will it be fairer? Definitely much fairer than what we have known up to now. It takes into account the globalization of international economy much more than the old landscape we knew, and which dated back to the 1920s.
You mentioned Luxembourg already and how this will play out for the country. Let's stay there a little bit. Many observers quote Luxembourg very often as one of the countries that will feel the brunt of these reforms in terms of less tax revenue coming in. And yet you have been very supportive and expressed also confidence in this being not of negative consequence for Luxembourg. How is that? How do you explain this?
There's been, first of all, a very complex way of looking at this, what the consequences of these reforms are. So there are some hypotheses that have been rolled out and that in a general manner say that small open economies, and that's what Luxembourg is, would be the losers in this context. Now, at first glance, this seems obvious, because you have also this redistribution according to the size of a country. But let's leave that aside for a moment. I think that for Luxembourg, these reforms will have more benefits than anything else, and than negative aspects. Let me explain why. Number one, we are a services country, and second, the most important sector for us is financial services. Now, in financial services, we have a carve-out of Pillar 1. So there, this redistribution, depending on the countries where companies are active, will not play. That's a very important point. The second point is the carve-out of substance that I mentioned before, which also takes into account EU rules. But more importantly, if I look back, what happened a couple of years ago when we implemented the 14 measures of BEPS of the OECD, which were agreed in 2015, when we implemented all the rules on transparency, exchange of information, many analysts predicted that Luxembourg would be a loser. Now, it was a close call, and it was difficult to know at the time if that would be true. Today, with hindsight, looking back 5-6 years, I can say that the financial sector is more attractive, more successful than it was 5 or 6 years ago. Why? Well, because we have adopted modern rules of transparency, which the market was calling for. The world has changed. Transparency is unavoidable. And by doing that, we have anticipated changes. We have done the changes faster, for example, than Switzerland. We have then benefited from Brexit. Had we not gone the way of transparency, had we not changed some taxation rules that we used to have, I think we would not have been as successful as we were in the context of Brexit, or more recently in general in the areas where we're strong, like investment services and the investment fund industry. So that I think explains why I'm rather optimistic. That being said, when you look at the goal that these reforms have, having minimum taxation worldwide, having rules that are common all around the globe, what does it tell us? It tells us that taxation will become less of an issue from one country to another. And so other aspects of attractiveness will come to the forefront. I think, for example, the financial stability of a country, the AAA that we have, that only a dozen countries have, will take up more importance in the future. The expertise that we have in our country, the toolbox that we have in company law, will be more important. So if I put that all together, I say Luxembourg will be a winner, last but not least. If we have common rules all around the globe in terms of taxation, and if we have fairer rules, then we will have what we have always been calling for, a level playing field. And if we have a level playing field, Luxembourg can play all its advantages out in a better way. And so in that sense, I'm very optimistic for the future.
Very well put. Thank you very much for sharing your insights. Minister, we look forward to having you on one of our future episodes of Focus On.
It was a pleasure, and I wish you a good seminar on taxation and all the other aspects of investment services in Luxembourg.
Thank you. Well, ladies and gentlemen, you have heard from Luxembourg's Finance Minister Pierre Gramegna, who shared his optimism that the level playing field that will be brought about by the international reforms will allow a country like Luxembourg to put forward all its other advantages. Indeed, while many people have considered investment structuring to be exclusively nearly about tax issues and looking for tax advantages, there is much more to it, and many other factors really are driving the choice for this or that jurisdiction. Luxembourg has been cast occasionally in an unflattering role in the media and in public opinion, but we will hear now from a panel of legal experts what considerations, what factors, what criteria really make and drive the choice for Luxembourg for this activity that is structuring investments, and how Luxembourg thus actually helps drive economic activity by helping investors put their projects on sound footing and give them the assurances that they need in order to make their projects become a reality. It is a pleasure now to hand over to our friend Markus Peter from GSK Stockmann, a Luxembourg law firm, who will moderate a panel of some of his peers, which I let him introduce to you.
Thank you, Nicolas. Good morning, ladies and gentlemen. I welcome you, and I'm delighted to welcome you here for our panel today, Focus on Investment Structuring. I'm also very pleased that I'm joined by the legal experts, which Nicolas just mentioned. So we have today here in our panel Katia Gauzès from Clifford, Luxembourg partner.
Good morning.
co-head of the corporate practice group. Good morning. We have Matthieu, Taillandier, partner at Arendt, and he's in charge there of the banking and also structured finance products, but also capital markets. And then good morning. And then we have as a third panelist, Vadim Totskyy. He's joining us from London. Vadim is working for Deutsche Bank since 2006, I think, and you are the head of the cross-product department there. Yeah, welcome to. Good morning, Vadim. So what we will talk about today is, not too much legal elements, not too difficult. We try to keep it a bit understandable because I think we not only have a legal audience, but we want to look into the structuring of the foreign investments which move into Luxembourg. And we want to explain what are the products which are available, toolbox and so forth. And I think we should first maybe hand over to Vadim, who has a long-time experience here with the Luxembourgish market. And I think you have a good experience with the certain products which are used by the bank here in the structured finance area. Vadim, go ahead and give us some insight on your experience over the last years.
Thank you very much for the introduction. Indeed, as part of my team mandate, we manage investment platforms for the investment bank at Deutsche Bank. We have an on-balance sheet issuance platform under the X Markets brand. We have a fund platform under the Primus brand. But what I would like to talk today more is the repackaging business, which is fairly sizable for Deutsche Bank. Specifically in the context of repackaging business, Luxembourg over the last 3, 4, 5 years become our prime jurisdiction for the issuance of a new structured notes and investment products. Now, why? There is really two main reasons I see and hear from the clients. First, Luxembourg is an onshore jurisdiction. It is seen as one of the preferred jurisdictions specifically for European investors. The other reasons, which is more relevant to our today's conversation, is the robustness and breadth of a legal framework that Luxembourg offers to the investors, as well as arrangers and sponsors like Deutsche Bank. Now, in this specific context, I really want to mention only 2 examples to keep it brief. One is securitization law. Luxembourg securitization law is robust and very powerful because it allows particularly multi-cell issuance vehicles to benefit from a statutory ring fencing. So when I talk to clients, they would like to see contractual ring fencing, and the addition of a statutory ring fencing give them additional level of protection and comfort, resulting in selection of Luxembourg as often their first choice of an issuance jurisdiction. If I were to look, and I did, to issuance statistics over the last 2 years, particularly over the last 18 months, the volume of issuance we've done out of Luxembourg is probably as big as all other jurisdictions we have combined. And we operate, our issuance vehicles operate in 9 jurisdictions. Maybe before mentioning another example of a powerful law that Luxembourg have, I just want to highlight that if you look at the repackaging industry and the initiatives in the industry, the 2 largest ones that we were involved recently, one is Aspire, where a number of dealers use the same issuance platform to offer products to the institutional clients. And another is standardized repackaging documentation, where again, a number of dealers try to standardize the format and the legal framework and documentation to offer to their investors. In both of those initiatives, the issuance vehicles were selected to be located in Luxembourg, which again is nothing but another example of more business and preferences to a Luxembourg issuance platforms. To keep it brief, I will only briefly mention another example, and that is a Luxembourg fiduciary law. Deutsche Bank has a sizable fiduciary law, fiduciary notes issuance platform in Luxembourg. And again, the size of that is comparable to the special purpose vehicle issuance that we use. The benefit of the fiduciary law, it also allows the robust legal ring fencing. But in addition to this, it allows us to use the infrastructure and expertise of Deutsche Bank Luxembourg SA, which is the largest European subsidiary of Deutsche Bank, Deutsche Bank AG. to provide both the legal robustness of ring fencing, but also the expertise and the infrastructure to their investors. So there's certain type of transactions where a classical SPV, special purpose entity structure, will not be sufficient to meet investor requirements. We can offer a fiduciary notes as a replacement to it and customize it to both investor financials as well as operational requirements.
So, thank you. So if I understand correctly, it's one reason is you have not just one product, you have like a variety of products from which you can choose. Second,
that is correct. We have investor demand for various type of products as well as various payoffs. Some investors demand fairly customized products for them. For example, a loan repackaging become increasingly more popular product for European investors, and not just European ones. The repackaging of a German law loans or registered notes is another product where we see increased demand. Both of them can be offered through Luxembourg. Fiduciary law allows a high degree of customization in certain cases, but a classical repackaging business utilizing a conventional SPV benefiting from the securitization law is a very, very large and, if anything, growing business.
Very good. Yeah. And maybe one last question before we move over to Matthieu. You mentioned some reasons why the structuring here is good for your investors, investor protection. What about time to market? Is this also something which works well here? So getting the product on the road, so to say, from the initial idea in the war room and bringing it then into the paperwork and also then to the market. Is this also something which, where you have had good experiences here, or?
Indeed, it is extremely important, particularly for both large institutional clients as well as for a smaller size client who look for a more standardized product. The time to market is extremely important. And last year, we certainly have seen the market volatility where we no longer talk about the weeks. We need to do a product in a matter of days. And the two initiatives I mentioned, one is Aspire, another is standard repackaging documentation, allow us to achieve that. The education and knowledge of the clients and the breadth of the clients who are familiar with the Luxembourg securitization vehicle certainly has increased, which on our side allows us to deliver this product quickly. On the client side, it also allows them to go to multiple dealers, increasing competition, seeking better returns as well as lower costs. And as you correctly pointed out, Luxembourg allows us to do that, not just from a timing perspective, but also from the efficiency and cost perspective.
Yeah, there was a reason why I asked the question as well as a lawyer, because sometimes, you know, the lawyers, we are a bit late with our documents, sending them to clients, but I think here everything seems to be okay. Very good. Yeah, thank you, Vadim, for this more practical insight. But now let's maybe move on a bit to legal aspects. Matthieu, given you are the expert here in your firm for the capital markets part and also the structured finance part, yeah, how do you see this area from a working perspective, lawyer's perspective? Do we have a lot of changes? We talked about legal framework being stable. Any new developments coming up? Yeah, let us know.
Yeah, thank you, Marcus. And was very interesting to hear also from the experience and the expertise from Vadim and the use that he is doing of Luxembourg instruments. So, but indeed, yes, the Luxembourg instruments and Luxembourg law is very active in all this structuring. I will say a few words about securitization vehicles first, and they were mentioned by Vadim as being deeply used by professionals, and they were incorporated into our law in 2004. And since then, we have seen really the use of these securitization vehicles developing a lot. We do have currently about 1,400 securitization vehicles in Luxembourg, incorporated in Luxembourg. We do estimate that there are about 5,000 compartments, and I will come back shortly to compartments afterwards. And altogether, the estimation is that assets under management for securitization vehicles are between 350 and 400 billions of euros euro. So it is these securitization vehicles are less known than the funds, but still they are part of our toolbox, and I know that Katia will come back to the toolbox later on, but they are totally part of this toolbox and very useful for Luxembourg structuring. In order to mention some of the advantages of the securitization law, as they were already mentioned by Vadim as well. One thing which makes our law very strong is that we do have compartments, and so ring fencing foreseen into the law itself. In addition to that, in addition to the compartments themselves, we've got express recognition of limited recourse and non-petition clauses, which is set by law. And why is it important? That is important because that is a very strong element for structurers and for investors into these securitization transactions. And usually in other countries, this is done through contractual agreements. And here in Luxembourg, we have it done and confirmed by the law itself. So of course, it makes things stronger than if it were only contractual, and it makes this a very useful tool for, as I said, investors on the one side, but structurers on the other side. Another word on the securitization law. After these 17 years of good services, it has been decided to modernize the law. There is currently a draft bill which is in front of the Parliament, and so we do expect these changes to be implemented into the law very shortly. Just to mention a few of them, one of the main change is that securitization vehicles will be able to be loan financed. Today it is something which is possible, but which is limited and which is sometimes a bit complex. There is a need from the market to be able to finance securitization vehicles through the issuance of securities on the one side, but also to allow some structures to be 100% loan financed. And so this should be possible very soon with these changes which will be done to the law. Another very important change will be the possibility for securitization structures to be actively managed. And some of them at least to be actively managed. It will not be open to all types of structures, but this active management was also something which was being asked and waited for by the market. And so we are very glad that the law will offer this opening in the near future. Also, it will be possible for securitization vehicles to grant security in favor of third parties. Today it is a bit limited in terms of who can benefit from security granted by securitization vehicles. Now securitization vehicles are being used more broadly in the setup of structured finance, and so they are not only used for this securitization itself, but more as I said, more broadly in the structuring of deals generally. And so it is important to extend the granting of security to third parties. And one last point, currently securitization vehicles are mainly SA and SARL, even if some other types of vehicles are possible. But the idea of the law will be to open that to new forms of vehicles. And here again, Katia will mention later on, notably the SCS and SCSPs. And so SVs will be able to be incorporated in the form of SCS or SVs in the future.
I mean, that's really good to hear. You know, we all know old cars need some new tires. Huh? So when the tires are used up, it's really good to put on new ones. But I think this sounds like really interesting developments for the securitization vehicle. And I think we also had the topic in mind about collateral law protection, or you go ahead, huh?
I just wanted to take also the opportunity of, talking about securitization, which is one of the capital market aspects of Luxembourg. Just wanted to say a word on the extended capital market for Luxembourg, because capital market is very dynamic in Luxembourg, especially the debt, of course, with all this securitization that we mentioned, but also with high yields being quite active in Luxembourg, EMTN programs going through Luxembourg. Vadim mentioned fiduciary notes being issued. That is something that we see and which is very popular in Luxembourg, and also very important market on sustainable finance, which has developed and increased a lot in Luxembourg. We should also mention the equity capital market, because notably during the last year, we have seen the explosion of the SPACs, even if equity capital market was already there in Luxembourg with a number of IPOs every year going on, but the SPACs and its momentum for these deals and for these special purposes acquisition companies has also, as I just said, created a development on equity capital market. And just to say a word also on the Luxembourg Stock Exchange, because the Luxembourg Stock Exchange is very present on debt as the Luxembourg market is. There are more than 37,000 notes being listed in the Luxembourg Stock Exchange, and we have seen also during the last years the development of the Luxembourg Green Exchange. It is celebrating its 5th anniversary currently this month, and it has been very successful with more than 1,000 green bonds being listed on the Luxembourg Green Exchange as well currently. So both the market itself and the presence of the Luxembourg Stock Exchange really create a good dynamic in capital markets in Luxembourg generally.
Vadim, one question. You also have your notes listed a bit in Luxembourg on the stock exchange, or?
Yes, we do. Okay. Not just fiduciary notes, securitization notes, as well as the ex-market notes are listed in Luxembourg. Obviously, we have multiple listing locations, but increasingly Luxembourg is becoming not just an important one, but sometimes a preferred one as well.
Okay. Good, thank you. Yeah, Matthieu?
Sorry. And a last point on which I wanted to intervene and that I wanted to mention, and which is maybe sometimes less known as really an active tool for Luxembourg, is our law on collateral. So I will just do a very short focus on Luxembourg collateral law, which is also a very efficient tool and which is also attracting some business to Luxembourg. A few points to be mentioned in respect of this law. So, first of all, taking security in Luxembourg is something which is very straightforward. I'm talking here about security in respect of financial instruments and claims, which are the main securities that we will take in Luxembourg. We've got a dedicated law on collateral, on financial collateral in Luxembourg, and so it is very easy to take a security over these shares, claims, or other notes that I just mentioned in Luxembourg. Basically, you just need to enter into a contract, and there are limited formalities to be complied with as well, which depend a bit on the instrument itself. But that is very straightforward. Another element to mention is that no hardening period will be applicable to such contracts. What does that mean? It means that in practice that if any of the entity which is party to this Luxembourg collateral arrangement becomes bankrupt shortly after the entry into the agreement, it will have no effect on the agreement itself. And this is something which will not necessarily be applicable to all other types of agreements. So it makes this security agreement and security arrangement very strong for Luxembourg. It is also to be mentioned that the parties can freely decide to establish what events will create the possibility for the pledgee, for the lenders to enforce such security. Usually, of course, that is the acceleration of the underlying loan. So a default under the loan and the acceleration under the loan. But according to Luxembourg law, you can also decide that some other criteria can be used in order to create this enforcement event and to allow the pledgee to enforce the pledge. So it allows a lot of flexibility in determining what will be the event of default and what will trigger the potential enforcement of the security itself. And then when it comes at the enforcement of such security, if we have to do so, two important things to know about Luxembourg. First of all, the enforcement of security is a one-day exercise, so you get no prior notice to send to any party. You decide to enforce. Of course, you need to prepare a bit ahead, but you decide to enforce, and then you enforce. And if everything is well prepared, that is a one-day process. And so you start the process at the beginning of the day. At the end of the day, enforcement is done. And over, I will say. You do not need, for example, if you enforce through appropriation, you do not need, for example, to evaluate the asset prior to enforcement. You enforce, and then you are able to start the evaluation process. So that is also a very powerful tool. And to come back on an insolvency scenario as well, because I mentioned how strong collateral arrangements are at the beginning of their life with no application of hardening period. I should also mention that even if the entities which are being involved are in an insolvency proceeding, you are still in a position to enforce security in Luxembourg. There is no stay in any actions in this respect, and that is also something which makes Luxembourg very powerful in this respect. And all these elements, and more generally how the law works, make that some deals are coming to Luxembourg, are being built in Luxembourg because of this law. One very well-known examples are the double Luxco structures that we have all experienced over time. But I will say not only some deals are attracted to Luxembourg because of this very powerful law on collateral arrangement, and so it is also an additional tool for Luxembourg.
Mm-hmm. Yeah, thank you, Matthieu. To me, that sounds really like a really strong creditor protection, right? I think all those elements which you mentioned do in fact well protect the party who provides the finances, the money, and I think this is also something, at least as a lawyer, which should also be the case. Legal framework should be really stable. And you mentioned some of the SPVs already, double Luxco structure. I think this is then a good topic maybe to hand over to Katia. I must apologize, I'm not a really polite host because I let you speak at the end. But I think it rounds well up if we move now a bit to the corporate toolbox, also as mentioned by Mr. Gramegna before. Give us some insight from your work, what you see, why those investment structuring is well designed to move into Luxembourg by use of our structures.
Thank you, Marcus. Yes, indeed. I think that there are three key things that are worth mentioning for the benefit of Luxembourg regarding corporate structuring. The first one is the use of Luxembourg law for major cross-border transactions. Mm-hmm. The second thing is the variety of the Luxembourg toolbox, as was already mentioned several times. And the third element is the business-friendly environment. I'll take them in turn. So to start with, the choice of Luxembourg law as governing law for major cross-border transactions. I think that this is a very key element. Luxembourg is indeed a small country, but it's also a neutral country and a very stable country with AAA. So when you have cross-border transactions and you have around the table some investors from Germany, other investors from France, and you have to choose the governing law for your transaction, it's a little bit delicate to choose one or the other. So in that respect, Luxembourg can be the natural choice for such transactions. And we see a lot of transactions governed by Luxembourg law in this respect. And I think that the Brexit also had an impact on that because many transactions were previously, before Brexit, governed by UK law. And since now the decision of the UK to leave Europe, some parties wanted to still remain within the European Union and have a governing law that would be applicable to the transactions that would be within the EU and benefit from those rules. And so in that respect, we've seen that Luxembourg has been, let's say, a natural choice for those players.
Maybe I can jump in. Apologies
Sure.
again. But given we talk about this Brexit, we have a person from London here also being present. Vadim, maybe you can also give us just briefly your input, what you see to this regard of governing law.
Thank you, Marcus. I would like to echo the comment that Katia made specifically in respect of the choice of law. While as a result of Brexit, we have not seen a wholesale switch from an English law, we certainly have seen an increase in clients inquiring about the alternative law being used, particularly for transactions with majority or substantially all the European investors. And in this context, Luxembourg law, choice of Luxembourg law, is certainly seen as Katia put it, a more neutral choice for investors, particularly when we have a transaction with a wide distribution across multiple European countries. An example of German investor and French investor agreeing on a choice of Luxembourg law is certainly an example I have seen.
Okay.
So if anything, the shift has started and the number of inquiries, questions being raised, and the Luxembourg law being considered as a law of choice have certainly been increasing.
Okay, thank you for sharing your experience. So some confirmative information from London for you, Katia. Huh?
Yeah,
Go
good
ahead.
to hear that this is a new trend and indeed continuing. Then the second thing that I wanted to mention that was already mentioned by our Mr. Pierre Gramegna is the Luxembourg toolbox. We have, thanks to this toolbox, a variety of options that are available to us for structuring the deals. So there are many options, whether regarding the investors, whether regarding the investments, and also many different types of legal forms that are available. And when you combine all those things, it's a very powerful instrument to be working on, and you also have the legal certainty together with that. And Luxembourg, I think, has been really continuously wanting to be adapting its legal framework. And one of the last very successful example that we've seen was during the transposition of the AFM directive in 2013. Well, we had, as Matthieu referred before, both the reframe of the SCS and also the decision to adopt a new company, the SCSP. That's the special limited companies. So how I think interesting to hear the story of that new legal form. Why is that? It's because when we prepared the law, and Luxembourg is a small community from the legal world, so we took all of the lawyers around the table and say, what do you see? What would be interesting for the investors to have? What is missing currently in our Luxembourg legal framework, and what is existing elsewhere that we could bring to Luxembourg? And in this respect, the working rooms were looking at limited partnerships agreement from Scotland, from Delaware, from Cayman Islands, from Jersey, Guernsey, and looking at all those different partnerships, different rules available, and seeing what was working in those countries, which were the main countries using partnerships, and what was not working. And combining all of this, we've made really a very innovative structure, very contractual oriented, that is now used in many, many transactions, soon to be used as well with the new reform of the securitization law. Used really mainly with our investment funds structuring. So
yes.
That I think
investment
is very
funds as well, correct.
Exactly.
Yeah. We will not discuss today investment funds, that's another panel, but you're right, I see that also really often in investment funds, yeah. And also being a German lawyer by training, talking about not easy, but light corporate law, I was used to have one law for each company type. When I came to Luxembourg, there was just one law for all the company types, and also much shorter. So that was also interesting to see. Huh?
Exactly. And I think that this is really the strengths that we have in our legal framework on the corporate world is that it's very flexible, actually, because you have to interpret. Not everything is written down and very unflexible, as we see in other jurisdictions. And as I was saying, the third point is really business-friendly environment. And that starts with the incorporation of a company. For the SCSP that we were just mentioning before, it just needs a paper and you sign the limited partnership agreement, and then you're done, and your company exists. For other type of structures, we see, for instance, the SRL or the SA that are very much used as special purpose companies and holding entities. For those, you need a couple of days. You need a notary, but again, this element is very flexible. Now everything is done via email and PDFs. So sometimes we see our clients say, "Oh, we need a notary, so it will take very long." That's not true, actually. We are very in a global environment, wanting to make the business go forward. And the different actors with whom we work know that we are in a stress environment and that we need to be quick and reacting quickly and reactive.
Yeah, correct. And for the notary, I think one element is also AML KYC clearance, which of course is also well observed, monitored, so that the documents are delivered to the notary, so he can check that everything is in order. And then we have, I think, to open a bank account, but then you can incorporate SAL or the SA quite swiftly.
Exactly.
Yeah, very
that's
good.
Right.
Very good. Yeah. Yeah, also a bit of the corporate lawyer, so also like to work in this field because it's yeah, quite interesting, and you can move quickly if you need to. Also for joint ventures, I think. I mean, talking about already Vadim, a bit a neutral place, Luxembourg. I think what I've seen at least is also to have joint ventures being brought to Luxembourg because it's different nationalities, they have different legal understanding, and to bring everything together into one platform, one SAL or one SA. The
right.
law has served to do that well here.
Yeah, and I think that Luxembourg corporate law is also very useful for joint ventures, for co-investment structures, also for private equity houses which want to be maybe or used to have certain habits in more offshore jurisdictions. And then we've seen Vadim earlier refer to onshore. I think that really Luxembourg, being at the heart of Europe, is seen as an onshore jurisdiction, and we've been able to sometimes migrate existing companies from foreign jurisdiction to Luxembourg without too many details being changed, which was very important from an investor's perspective, because typically when you move from one jurisdiction to another, you say, oh, okay, but it will be very difficult to explain to all my investors why this, and this is changing. And actually what we experience is that you can keep more or less 95% plus of the existing framework that you have and all your contractual agreements, and really tailor-made them, but that the investors will be still in an environment that they know, which I think is also very important from a business standpoint.
Yeah, I think also very important, it's not that investors think when we go to Luxembourg we have to speak French and we have to draft everything in French. Well, that's not the case. Language-wise, I think we are all already, I think Matthieu as well, main language in the day is English, to work in that language, and documents are drafted. So
that's true, and it's very important to mention, because even though French and German together with Luxembourg are the official languages in Luxembourg, really English is the language in which we all commonly communicate with or we work with, and the notaries also accept, and for legal documentation, English is really the main language that we use on a daily basis.
Yeah, correct. And also when we go to the courts, I think this is grabbing together also all the topics we had, the structuring, the banking finance part, and also corporate part. You talked about enforcement, also for those collateral arrangements, pledge agreements. To the courts you have to go, of course, in the official languages, in French and also in German, but you can also produce evidence documents in English language, and the court system, as far as I can see it, is also working efficiently. I think that's important also for the creditors. I mean, it's nice to have the law allowing you to not having a hardening period or to keeping your pledge in place, but if it takes 2 or 3 years to win in court, that's also not good for the jurisdiction. But luckily, that's not the case here. Yeah, very good. Did you want to add something else or not? Because I think we're also nearing the end of our panel. Okay, good. Thank you,
That's
Katia, Matthieu.
I could take hours to speak about Luxembourg structuring, but if you stop me, then
Okay, no, we'll do that at another occasion, yeah?
Sure.
But then I want to thank the audience for your attention. We hope this has given a bit of insight to you. And I also want to tell a big thank you to the panelists who have taken time to be here today with us. And now I hand over back to Nicolas for the next point on the program. Thank you very much.
Thank you very much.
Well, thank you very much, Katia, Marcus, Matthieu, and Vadim. This was a very interesting discussion for all of us watching you lay out to us the legal reasons that make Luxembourg an attractive investment hub. And in particular, thanks to Vadim and to Deutsche Bank for the testimonial where you explain how a major player like Deutsche Bank sees the interest in Luxembourg's regulatory and legal framework. Ladies and gentlemen, we will now switch from the legal view to the tax view, and I will be handing over to Patrick Mischo, the managing partner of Allen & Overy Magic Circle law firm here in Luxembourg. Patrick, the floor is yours.
Thanks very much, Nicolas, and thanks for everyone joining us today for this session on tax aspects relating to investment structuring, a session entitled Tax Advice Sunsets on New Dawn? So as we heard from the previous panel, in Luxembourg we have this great legal toolbox. And the toolbox provides for a very broad range of different features. We heard about them. The attractivity of the securitization regime, the flexibility of the corporate law, and some others like fiduciary arrangements or the Collateral Act. So all these features we have in this legal toolbox have allowed Luxembourg to position itself as a key hub to raise capital and structure investments via capital markets or via investment funds. When I say capital markets, I'm really thinking about the issuances of bonds or notes out of Luxembourg issuance vehicles, often instruments actually listed on the Luxembourg Stock Exchange. When I talk about investment funds, I'm really thinking about retail funds like UCITS, but also in particular alternative investment funds, where Luxembourg has developed into a key hub for structuring over the last 10 years, covering different asset classes like private equity, real estate, infrastructure, and debt. Obviously, once you have raised the capital, you need to deploy it. You need to invest it into the economy. When financial institutions or corporates are doing so, they are obviously looking for a maximum security in terms of legal, but also in terms of tax treatment of their transactions, of their investments. That's, of course, where sophisticated tax advice is required. I think it's fair to say that over the last 10 years or so, the international tax environment has changed dramatically. This, of course, comes as a challenge to tax professionals. On top of that, we expect further change in the future. And as we heard from Minister Gramegna in his introductory speech, there's more change to come, in particular at the level of the OECD with the Pillar 1 and Pillar 2 initiatives. So what are the challenges tax professionals face? And this is not only about tax advisors, it's also about the in-house tax functions at corporates, at financial institutions. Whereas probably 15 years or so, the internal in-house tax function of a corporate or an asset manager or financial institution was mainly focused on tax optimization. I think it's fair to say that today, the main focus of the in-house tax function is really about tax mitigation. And when I say tax mitigation, it's about ensuring, at least to the extent possible, certainty when it comes to structure a transaction or investment. And that covers both the investment phase at inception, but also the life cycle of the investment, and last but not least, the exit. It's really about ensuring to get a maximum of legal security on the tax side in that respect. And that, of course, is where we come in as tax advisors. Our job is really to help the tax directors of the financial institutions, of the corporates, to navigate this ever-changing, complex tax landscape. So, tax advice, sunset or new dawn, question mark. That's a question we're going to address at the very end of this panel, and I'm very happy to welcome Petya, Dimitrova, and Vincent Lebrun, who are joining me to discuss these interesting topics and to, at the end of the session, also answer that question. So let me briefly introduce the speakers. Petya is a partner with ATOZ here in Luxembourg. She is specialized in corporate and international tax law, and she is advising corporates and asset managers, investment funds on a regular basis, also on the investment and M&A side. Vincent is a partner with PwC here in Luxembourg. He is also leading the alternative industry sector at PwC in Luxembourg. He has more than 20 years of experience advising on clients on investments, but also on the formation of investment funds. So thank you very much for joining, and a very warm welcome to the two of you as well. So let's dive into the themes straight away. And let's turn to the past in the first instance. As I mentioned, there have been dramatic changes over the last 10 years. So, Petya, why did the international tax system change so much, and how did it change?
Thank you, Patrick, for the introduction, and very happy to be here with you today. Yes, in the last 10 years, so the international tax system has never seen so many changes in so short time frame. As Minister Gramegna mentioned previously, the international tax rules has not changed for more than 100 years before, and the past 10 years have been marked by huge changes, especially by the base erosion and profit shifting project. This project, the so-called BEPS project, this project has been announced as a fight against aggressive tax planning by corporates. But it's important to understand how this project came and how it emerged, in what context. We can say that this project emerged in the context of a slow recovery from the 2008 crisis, subprime crisis, austere budgets, and a global need for tax revenues for the governments. Also an increased attention to international tax affairs, such as Apple, Amazon, Starbucks, where social media put a lot of pressure on governments to get multinationals paying their fair share of taxes. And more generally, the globalization made that countries realized that, this created a lot of competition, tax competition between countries. They realized that existing rules are not anymore there, are not anymore sufficient to tackle challenges at international level. And so they realized they are old-fashioned and they have to be changed. So this is the broad context of how this project emerged. Mm-hmm. And what is BEPS? BEPS have been defined as aggressive tax planning or aggressive tax planning by multinationals, which were exploiting mismatches and gaps in international tax rules in order to make disappear profits for tax purposes, and also to shift profits to low tax jurisdictions without having any real activity in those jurisdictions. So the aim of the project was to have those practices becoming illegal by introducing new tax legislation. Then in 2015, there were the 15 actions of the BEPS action plan, which were adopted by the OECD. Those actions have been giving recommendation for some of them, for other of them, minimum standards. We should, however, note that at EU level, the recommendations have become a minimum standard as well. Mm-hmm. So we have seen more of tax changes in Europe than we have initially expected. So we have seen the implementation of ATOZ 8.2 directives, but also increasing tax transparency rules and tax reporting rules, such as the DAC 3, 4, 5, and 6 directives. And this is still not finished. I mean, there are a lot of initiatives at the level of OECD as Pillar 1 and Pillar 2, and also at EU level for example, shell companies initiatives. We are still to see upcoming changes in the international tax environment.
Thanks, Petya. And we'll get back to the changes ahead of us in a minute at the end of the panel. But as you explained, dramatic changes, more complex rules, a lot of rules focused on substantive tax, but also a lot of rules regarding transparency, exchange of information. So a shifting landscape. And how did that affect both of you actually as in your role of tax advisors? Did your job change as a result of this additional complexity, this ever-changing tax landscape? Maybe we can start off with Vincent.
Thanks, Patrick. Well, personally, as you said, I started my career as a tax advisor in Luxembourg more than 20 years ago. Back at that time, one may say that it was more about tax structuring and tax optimization. And we as tax advisor, we were able to say, okay, it's black or white. But further to the introduction of all those new tax measures that Petya mentioned, this has introduced a lot of complexity, tax uncertainty, and also the implementation of tax concepts, which are actually totally new. And of course, those rules are somewhat quite disruptive in the sense that it's impacting players operating through Luxembourg, but also at the level of Europe and internationally. Today, one may say that I have sometimes the impression today, since a couple of years now, that those new rules are really in force, that we are sometimes more a tax risk manager or a tax compliance advisor. So I would say quite disruptive, but we stay flexible and we adapt to the situation. But the main concern that we have today is probably the tax uncertainty, which has resulted from the implementation of those new tax rules. As Petya mentioned, it all comes from the OECD BEPS ban. Europe has been quite quick and fast to implement those, probably too quickly, because now those rules have been transposed into domestic law. Of course, Luxembourg has been, as usual, a fast runner to implement those new tax provisions. But there are a lot of open questions about how those new rules are working when they get applicable. And of course, there are a lot of uncertainties about their interpretation. Just to give you some example, if you look at the EU directive on ATOZ 1 and ATOZ 2, clearly sometimes the comments to the directive refers to the commentaries to the OECD BEPS ban, but we know that Europe has implemented some of those rules in a different way than as proposed by the OECD, and therefore there are quite, let's say, gray areas today. As I said before, it was more white and black. Today it's more gray. It has impacted many players, including on very basic structures. OECD, as mentioned by Petya, was more targeting multinationals, but unfortunately those rules are also applicable to, let's say, investment fund manager, alternative fund managers, and so on. And therefore, today, even if we are still doing, let's say, tax structuring, we are just coming to it with a different angle, with the tax risk management, the compliance one, on the reporting and so on. And therefore, since the rules are new, there are open interpretations, so often we are just in a position to make recommendations to our clients to help them to go through these new rules, to understand them. And often, unfortunately, it comes back to a management decision at the client level to decide to go for one route or the other one. So that's a little bit the how the role has evolved on my side from structuring now to structuring compliance and as a risk manager.
Absolutely. Thanks for that, Vincent. So no more black and white solutions to issues which are popping up when you do an investment, when you structure a deal. Much more uncertainties. You need to manage these uncertainties and also help your clients as an advisor, to get to the best result, even though there's not always an answer to any question. So it's really about risk mitigation, right? So Petya, how did you actually go through that period of time? I think Vincent mentioned the word disruption. So it has been kind of a disruption. How did you? What's your personal experience?
Yeah, I agreed with what Vincent said. It's uncertainties everywhere today, not only in Luxembourg, and times are challenging for everybody. Kind of uncertainty is the new normal in Europe and in the world. So this was a very challenging for tax advisors and for me as well, because over the past 10 years, I had to adapt every single day to the new challenges. I have to make my own interpretation of rules which were not clear guidelines existed or not case law existed. So just to tell how times are challenging, you have today some of the rules which have been implemented for the Act 6 in France or in Belgium, which are already challenged in front of the Court of Justice of the European Union, even though they are pretty new rules. We can come in a situation where those rules just implemented are not in line with EU law as well. So we had to adapt every day. So everybody had to adapt every day. We cannot blame governments neither not to having clarify those rules, because this is not as easy as we can imagine it. Rules have been introduced so quickly by the European Union, so that they didn't have the time or didn't took the time somehow to think about the consequences of those rules. So it's about tax advisor. Tax advice became very important in that challenging times for clients. Everything has to be anticipated, and we have to think and make our own interpretation, which is a difficult exercise.
Sure.
Fortunately, in Luxembourg, there are several groups, working groups, which are allowing tax advisors to exchange and then to make a sort of a guidelines, which hopefully could also help tax authorities to make their mind and to take their positions on these new and clear rules. We should bear in mind as well that these rules are new for the tax authorities as well.
Sure.
So it is very important. What we can take out from this is very important, that every single situation is carefully reviewed and every single advice is really adapted to the situation of the client.
So actually a lot of complexity, a lot of changes and open questions, and definitely a need to have a dialogue among tax advisors with the tax functions at the financial institutions or the corporates, and also dialogue with the authorities, because everyone is basically in the same boat, right? Having to cope with all these new rules. Over that period of time, actually, Luxembourg evolved into a key hub in Europe to structure investments, in particular in the alternative investment fund space. So, Vincent, what happened there? How did that go? How did we get to that position in which we are today?
I think the IFMD directive has been really the game changer for Luxembourg. Before this directive, Luxembourg was, of course, playing a major role into international transactions and so on, but it's clearly the IFM directive and its implementation here in Luxembourg by also introducing the Luxembourg Limited Partnership System, the reserved alternative investment fund regime and so on, which has really allowed Luxembourg to play a major role today on, let's say, for the fund managers, especially for the alternative fund managers. So clearly, Luxembourg is today a major investment fund hub, not only within Europe, but also, I think, on an international basis. We clearly see a very big trend in the sense that we see the major alternative fund managers, let's say, setting up their structure, their products, their governance, their functions here on the Luxembourg ground. So that has, I think, to me, be the real game changer. And thanks to, let's say, the legal framework available here in Luxembourg, the tax system to a certain extent, but also the regulatory environment, and of course also the regulatory constraints, because if you want to have your funds managed out of Luxembourg, there are some regulatory obligations in terms of substance, governance, and so on. That is really bringing, let's say, true substance on the Luxembourg ground in terms of functions, not only from the back office side, but we see middle office and also front office functions. So, well, Luxembourg is clearly, I think, a front runner today. And this trend, I think, should really continue over the next year. And we know that due to the pandemic, the alternative fund manager are playing a key role into the economics. And so they will continue. Fundraising is booming. The level of acquisition and transaction is booming too. So that creates a lot of, let's say, opportunities for Luxembourg. So I think what is key for Luxembourg would be to continue to service the fund managers in the right way. I think what's going to be key is to make sure that managers which have a multi-investment strategy, that we can actually propose products here in Luxembourg in order to fix those different investment strategies. So clearly what the main objective should be for Luxembourg and continue to be is really to be a one-stop shop for the fund managers. And so they are not only setting up their fund structure here, but also the management companies. OECD, BEPS, has introduced the concept of regional platforms, and that's also something that Luxembourg can provide for. So nowadays, I think we have all the tools to continue to be extremely successful, but probably we should just keep an eye of what the other member states are doing. Sure. Because clearly some of them want to play a role. I will not mention names here, but because they are the usual suspects. But this is just to say that let's stay open-minded. We need to stay flexible and adaptable, and see what the others are doing in order to stay as a front runner, as I mentioned before.
So there, again, on the operational side, dramatic changes over the last years, triggered by regulatory changes, but also political events like Brexit. But definitely, as you explained, particularly in the asset management sector, asset managers really, added high added value functions to their Luxembourg setups and plug them into their internal organizations, their global organizations. And these people are actually, helping to raise capital out of Luxembourg, but also helping to structure the investments out of Luxembourg. Obviously, your explanations primarily were focused on the asset management field. I think it's also fair to say that in the capital markets segment, there have been also loads of developments over the last 10 years since the previous financial crisis. Obviously, the European Commission also has actively promoted the Capital Markets Union, so it has become extremely important to take this a step further. And again, a certain number of tools which we have in the Luxembourg toolbox have been essential to do that, in particular the Luxembourg securitization regime, but also the presence of the Luxembourg Stock Exchange, of course, which is the primary listing venture for bonds and notes, including green bonds more recently. Of course. So a lot of activity also in the capital markets space. And obviously, once the capital has been raised, whether that's by way of a fund or by way of a notes issuance, it needs to be deployed, it needs to be invested. And this is actually happening also out of Luxembourg via these investment platforms you mentioned. That's all. But what does that actually mean, Petya, back to you? What does that mean from a tax perspective, this trend, this evolution we have seen over the last 10 years?
Yeah, from a tax perspective, things have followed the trend and, of course, the needs of adaptation to the new rules. This is for sure. So it's clear that today structuring or restructuring have to be done even more carefully than in the past. because of all existing anti-abuse legislation, such as the general anti-abuse rule or the principal purpose test, but also all other limitations introduced by the ATOZ directives as interest limitation rules or anti-hybrid rules. So those rules are applying at several levels, so I mean, careful attention have to be paid on that. I mean, it is also true that anti-abuse legislation is not new in Luxembourg, and companies without any substance, so letterbox companies, have not been an option even before the emergence of the BEPS action plan. So
that's right, because actually I remember when I started my career back in 2001, the discussions around substance were already on the table at that point in time, of course. So it's not something new from a tax advisory perspective.
Nothing new. I mean, this is something that Luxembourg tended to implement or to pay attention or to be sure to tackle for many years now. Then, having said that, it's still companies have to pay attention and to be more careful today and to be more prepared in front of challenges or questions from the tax authorities. So we can expect more challenges, more questions from tax authorities. And we have to be able, and also the clients have to be able to demonstrate the economic purpose of their structure and also to be able to document properly the economic flows in their structure through transfer pricing documentation, for example. I mean, the documentation and careful structuring became key over the past 10 years. I mean, a robust documentation of every transaction, and the main point is really the economic reason of a structure. So the role of a tax advisor is, of course, to collect all this information upfront and then to understand well the strategy of the client in order to give the best tax advice. So we have to anticipate all steps in the structuring or in the structure from the beginning through the life of the investment until the exit, because with the new rules, tax implication could be huge for a client. So everything has to be anticipated from start. And what is very important for companies which are doing cross-border investment or which have cross-border business activities, they have to have the appropriate substance. There is no one-fits-all approach, but one-size-fits-all approach. But what is the important thing is that structure have to be aligned with operations, and substance have to be appropriate to the level of activity into the company, in order for the structures or the companies to be able to benefit from the EU directives, for example, or the double tax treaties, because these are the challenges nowadays from other countries as well, where what is the most important thing is that structure is aligned to the operations.
Exactly, and that's actually what came out as a result of the BEPS action plan, the requirement to basically align economics with investment structures, right? That was really requests from the OECD. And coming back to what Vincent explained before, probably Luxembourg is pretty well positioned today because the operators, the financial institutions, the asset managers, they have, operations on the ground. On that one, is there anything you wanted to add, Vincent, on this topic?
Not really. I think Petya said it all.
Okay, excellent. So maybe then, looking more towards the future, right? We already touched on it. There's challenges ahead of us, and I think Minister Gramegna also, in his introductory speech, mentioned the OECD initiative with Pillar 1 and Pillar 2. So there's going to be challenges, but probably also opportunities. So my question really is, what's your take on that one? Maybe Vincent, if you want to go first.
Sure. Well, on the challenge side, I would see first the backlog. I mean by that all those new tax measures and provisions are not only impacting structures that we are implementing for the time being, but it's also impacting anything which has been implemented in the past. And when it comes to alternative fund manager, we should not forget that when they launch a fund, it's in general for a period of 10 years' time. So they look really for tax certainty. So we need to fix the past, and in order to provide the right product for them, to anticipate, let's say, unforeseen tax challenges, we need to come up with, let's say, appropriate structures right now. I think the second challenge is probably pandemic. It's crystal clear, even if I don't have a crystal ball, that some other tax measures will come. So let's see whether this will also be, let's say, disruptive, especially in Europe, because we know that Europe has a tax agenda. Another is probably competition. As I said previously, let's keep an eye on what the others are doing. It's always good to see what they do, because some are coming up with, let's say, a new tax proposition or tax reforms which are taking into account to a certain extent those new tax measures. So let's keep an eye. Never rest on our laurels. Let's stay open-minded and see whether and how we can continue to improve our system, not only from a tax point of view, but also from a regulatory and legal perspective. And then I think for me the major challenge is the tax uncertainty. Because as I said, fund managers, they want something which will work for the next 10 years. Of course, this is not always something that we can provide them right now. We said before it was black or white. Now it's a little bit gray.
In particular because the rules are changing all the time. So obviously you can't predict how the environment will look like in 7-8 years from now. But of course it's about providing sustainable tax advice. As you said, these projects are up and running for 10 or more years. So you need to anticipate the future, at least to the extent possible.
Yeah, but anticipating the future is already difficult, since we are still struggling on the interpretation or the application on some existing rules which have been implemented. That's right. But otherwise, just on the opportunity side, before giving the floor to Petya, I would say, well, Luxembourg is extremely well positioned. It has built an incredible reputation. Of course, reputation is something that you need to, let's say, it's like with a flower. You need to bring water in that every day. So we are still extremely very attractive. As I said, let's check nevertheless what's going on elsewhere to stay, let's say, highly competitive. Because, well, if Luxembourg wants to stay as the front runner, we need to stay open-minded. And what we absolutely need to ensure is that the added value proposition of Luxembourg stays on the top. So that's, let's say, the challenges and the opportunities I see.
Yeah, thanks for that. Petya, anything you would like to add from your perspective?
Yeah, from my perspective, the biggest challenges as well will be the uncertainty or the complexity of the rules. The new rules upcoming, so with the several initiatives, as mentioned, as talked about by Pierre Gramegna already, we have Pillar 1 and Pillar 2, which are tending for a harmonization at international tax level of tax rules. But also there is, the crisis, of course, it could be seen as a big challenge, because tax authorities or governments will have the need to get some additional tax revenues in order to recover on the short term. However, it has been in several occasions mentioned by the Luxembourg government that this is not the purpose in Luxembourg, so to increase taxes. I mean, so this is because, in fact, I think Luxembourg realized that in order to get out of the crisis, they have to generate more tax revenues. But generating more tax revenues is coming from generating more business and attracting more business in Luxembourg. So we have to stay competitive instead of increasing taxes. So I think this is already the case in Luxembourg. So we are well positioning. Luxembourg is going out from the crisis pretty well. So we have to build, with the harmonization coming from this new legislation and the tax competition between countries decreasing, we have to stay competitive by using first all other tools Luxembourg has, as already mentioned, all legal tools and fund industry. But Also, we have to focus on building on existing operations in Luxembourg. This is very important because we have a lot of operators in Luxembourg, as Vincent explained before. So over the past 10 years, Luxembourg has been a success, especially in the fund industry. So we have to build on what we have already as well. Yeah, I think it's, there are as well other initiatives which could be a challenge. And at EU level, for example, shell companies which aims at introducing substance at EU level for tax purposes. However, it's really regrettable because we have so many tools today that are available to tax authorities to tackle aggressive tax planning, it's regrettable that the EU Commission didn't make a kind of assessment first before going into more complexity in international tax legislation.
To make the assessment first to determine whether ATAT 3 is actually required.
Exactly.
Because ATAT 1 and 2 are at the disposal, of course, of the authorities to challenge aggressive planning already, right?
I think we have all the tools necessary today to tackle aggressive tax planning and tax evasion. And we don't need more complexity into the landscape.
Sure. But obviously, as we said, we think that we are, as a jurisdiction, well placed, and the operators are well placed as well, because they have the boots on the ground, they have the operational presence, which they built over the last 10 years, and that's a good starting position also in light of the potential future develops. But clearly we need to keep an eye on this consultation on the shell entities, which has been launched by European Commission, and we'll have to see what the outcome will actually be, right? Okay, so that has been incredibly interesting, but we didn't answer to the question yet, the question which has been raised at the beginning of the session, tax advice, sunsets on New Dawn. What's your take on that one? The question is addressed to both of you. Maybe Petya, you want to go first?
Yeah, we have already talked about all this complexity which is existing around nowadays. So this is definitely a new dawn for tax advice because, people really need nowadays experienced and a sound tax advice on their operations and on their investments.
Yeah. Vincent, anything you would like to add?
Well, difficult, but definitely I agree. It's a new dawn. The complexity in the tax uncertainty makes clear that anyone who wants to have a career in tax will have a long career. Just to give you some comparison, I think in the past a fund manager with one tax director was able to manage his tax affairs.
Yeah.
Not only on the structuring side or on the compliance side. Now, when you look at the tax teams that our clients are having, of course they have a large number of people now on board because the tax compliance reportings are so huge. And so sometimes it's the question whether they should do it internally or give that to a service provider. Clearly, no, bright future for tax advisors in the current changing tax environment.
Yeah, you're pretty right, and we have seen that also, on the side of the financial institutions or the asset managers, they had to beef up their own in-house tax functions, of course, to cope with the changes and with the compliance requirements. So to answer the question, clearly a new dawn, I think we can all agree on that one, so probably a bright future for young professionals who want to build a career in tax advice. So I think that really brings us to the end of this panel. Petya, Vincent, many thanks for this very interesting discussion, and thanks to all of you for joining us today for this session on tax aspects relating investment structuring. Thank you very much indeed.
Thank you, Patrick.
Thank you.
Well, dear Petya, dear Patrick and Vincent, thank you very much for this very interesting discussion on the tax considerations around investment structuring. This also brings us to the end of this episode in our Focus On series. I hope you found this as interesting as I did. I think it has clearly shown that as the last panel has concluded, there is a bright future for tax advisory services simply because of the growing complexity of the activity around investment structuring. We have also heard many of the arguments and advantages that Luxembourg will be able to leverage once there is a level playing field. So a lot of optimism is conveyed by the different speakers today, whether it is on the political sphere, on the legal sphere, or on the tax sphere. With that, ladies and gentlemen, let me also thank you, the audience, for joining us again. I would also, of course, like to thank our sponsors who have supported us again in this particular episode, and you will see their names in the end of this program. Let me invite you also to the next episodes, and actually on the 27th of September, so at the end of this month, we will focus on Italy, showcasing the different solutions made in Luxembourg for Italian asset managers and Italian investors. After that, in October, we will have two other digital conferences, one which will be focusing on Southeast Asia, and one that is our yearly Sustainable Finance Forum, which will also this year again be fully digital. You can find more details on these and on the programs of these conferences on our website, luxembourgforfinance.com. With this, ladies and gentlemen, thank you very much, and looking forward to seeing you soon.